Supermicrocomputer helps enterprises equip data centers with technology to optimize for artificial intelligence. Its liquid cooling solutions are highly sought after as a better way to cool down these GPUs at a lower cost. And so Supermicrocomputer has seen its revenue soar as companies spend hundreds of billions of dollars on these data centers. So does that make the stock a buy for 2026? I'm going to take a closer, more comprehensive look at the company and answer that question in this video.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So you can see that increase in revenue I talked about in the introduction of the video, following the rising effectiveness of artificial intelligence, following the launch of ChatGPT. Demand for data centers has absolutely soared, and Supermicrocomputer saw its revenue jump from 5.2 billion in 2022 all the way up to 22 billion in the most recent trailing 12-month period. That's huge growth in a short amount of time, but even if you look back a decade, the company has increased its revenue by a compounded annual growth rate of 30%. And looking ahead, given the spending plans of the companies that are building these data centers, Supermicrocomputer has excellent growth prospects for at least the next few years. But I also wanted to look at profitability. How lucrative has the business been? And one of the ways I evaluate this is by measuring the return on invested capital, which has been pretty solid for Supermicrocomputer over the previous decade, but of course more significantly so in recent years. Since 2022, the figure has averaged about 29%. It's gone as high as 40% before coming down to 21%. But looking before the increase, let's say before the launch of ChatGPT, this was not a very lucrative industry. Its ROIC hovered around low double digits to mid double digits. And if I were to share with you some of its competitors' margins, they are also relatively skinny. This industry, and by its competitors, I'm talking Dell Technologies, Hewlett Packard Enterprises. Looking back at their historical profit margins, it's not very lucrative. They're not in a position to generate very strong margins, and I don't expect that will be the case going forward either, because the purchasers of this technology have strong negotiating power against the suppliers of the technology. So I get a similar answer when I look at the company evaluating the operating cash flow to sales ratio. Highly volatile, fluctuating, but at no point over the previous decade has this figure surpassed 10%. So again, reiterating what I said earlier, not a very lucrative business, not a very lucrative industry to participate as a supplier. So let's look at valuations then. So what we've seen from the previous financial metric was that the company is experiencing great revenue growth, but those revenues are coming at relatively skinny margins. And so when I measured the market multiples, we can exclude the price to operating cash flow because it's negative. That's not a concern for Supermicrocomputer. I've talked extensively about this for Supermicrocomputer. I've been following this company for a few years now. I mentioned that the supply-demand balance, it's just a matter of when you're growing revenue so quickly, you're buying up material to deliver to your customer. And so there's a cash flow cycle that catches Supermicrocomputer on the negative side when revenue is growing so quickly. It's spending more for the inventory, and then the customers it's giving it to are taking time to pay Supermicrocomputer back. So that cash conversion cycle is causing negative cash flow. But when revenue is increasing as quickly as it is for Supermicrocomputer, it's not a big concern. The only reason it became a big concern, if you remember, Supermicrocomputer was enthralled in some financial reporting scandals. Its auditor resigned and said that the management team is not being transparent. And so when you have that kind of issue in conjunction with some negative cash flow in certain periods, then it became a bigger risk. But I've been saying I don't think that's a big risk for Supermicro computer stock investors. It's just a cycle of paying for inventory and then waiting for your customers to pay you back. So I also calculated a fair value using my intrinsic value calculator, my proprietary DCF model. And the intrinsic value came to $26.60. Compared to the current market price of $34, the stock looks slightly overvalued. Even on the forward PE basis, it looks slightly overvalued given the company's margins and given the company's trajectory. It looks slightly overvalued according to its historical price levels. So both valuation metrics point to a stock that's slightly overvalued. And given the other financial reporting concerns that are still relevant because it's still the same management team operating the company, I don't think it's an attractive buying opportunity at the current market price. So I reiterated my hold rating today for Supermicro computer stock. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.